Acadian Asset Management absolutely crushed consensus this quarter. I mean, just a massive beat across the board. And the stock is soaring today in response.
Oh yeah, the market is completely eating this report up.
Right, so we're talking record management fees hitting 176.5 million, U.S. GAAP diluted EPS leaping an insane 171% to 76 cents a share.
Yep.
And the management commentary and forward guidance just point to even more momentum. It's a blowout.
It really is. It's just a phenomenal quarter.
Exactly. So today we are jumping straight into a deep dive on Acadian's Q2 2026 earnings presentation and the press release. We're going to unpack exactly how this firm is operating right now.
Yeah, because we're looking at a pure play systematic asset manager that is, well, they're basically operating with the efficiency of a massive tech platform at this point.
Which is exactly what we want to break down for you today. If you're managing your own portfolio or just tracking how these massive financial engines generate cash, this report is a perfect case study in operational leverage.
For sure. I mean, to really get it, you have to look at the sheer scale of the assets first.
All right, let's hit those AUM numbers. Assets under management reached a record high of $232.7 billion in Q2.
Which is just a wild number.
It is, because if you look at Q2 of 2025, they were sitting at $151.1 billion. That is a 54% jump in 12 months.
Yeah, over $80 billion in new assets flowing in.
In a single year.
Right, and adding $80 billion in a year completely changes the gravity of a firm. Managing $150 billion is already incredibly difficult, you know?
Absolutely.
But stepping up to $230 billion requires structural integrity that most firms just don't have, and you see that integrity directly in the revenue line.
Yeah, the record quarterly management fees of $176.5 million, that's up 44% year over year.
Exactly, and the earnings metrics followed right along.
They did. We mentioned the GAAP EPS leaping to 76 cents, but they also reported economic net income, or ENI, which we'll dig into later. Their ENI EPS came in at $1.33, which is up 108%.
A massive jump.
But here's where it gets really interesting for me. Their ENI operating margin expanded from 30.7% a year ago to 40.3% this quarter.
Yeah, 959 basis point jump.
Almost 960 bips in margin expansion in a single year. That's what you expect from a SaaS company, right? Not an asset manager.
Well, it's because of how they're structured. In traditional asset management, like fundamental shops with human portfolio managers, growth is super linear.
Right, if you launch a new fund, you have to hire a whole new desk of analysts.
Exactly. Your fixed costs just rise right alongside your AUM. But Acadian doesn't do that. They rely entirely on systematic investing.
So a heavy algorithmic quantitative models.
Precisely. They've spent 40 years building these automated pipelines. So they don't have to hire 100 new Ivy League analysts to manage that extra $80 billion in AUM.
The marginal cost of that next billion is practically zero.
Right. Their comp and benefits went up a bit this quarter, sure, but nowhere near the rate of their top-line revenue growth. So all those record fees just fall straight to the bottom line.
Which is how you get a 40.3% operating margin in finance. Okay, so the operational leverage is clearly there. But the obvious question is, where is all this fresh capital coming from? Institutional capital is notoriously fickle, so why are they throwing money at Acadian right now?
It all comes down to the net client cash flows. They brought in $4.3 billion in NCCF just in Q2 alone.
Which translates to a 9% annualized organic growth rate.
Yep. And this marks 10 consecutive quarters of positive net flows.
10 quarters. I mean, through inflation scares, rate hikes, all the macro volatility we've had over the last 2.5 years, more money is coming in than leaving.
It's incredible consistency. The report points to their enhanced and extension equity strategies as the main drivers.
So what's the actual hook? Why is the capital sticking around?
Alpha. It's just that simple. Institutions only care about outperforming the benchmark, and Acadian's track record here is honestly staggering.
Let's hear the stats.
So weighted by revenue, 96% of Acadian strategies outperform their benchmarks over the 3-year, 5-year, and 10-year periods.
Okay, wait. I have to push back on that.
I know, it sounds fake.
It does. 96% of their strategies are beating the market over a 10-year horizon. Every indexing advocate tells you active managers never beat the market over a decade. It's supposed to be statistically impossible.
Right, but you're thinking of human stock pickers. Humans get tired. They get emotional. They panic sell during a geopolitical shock.
They fall in love with their own thesis.
Exactly. But Acadian's algorithms don't feel fear. They just ingest millions of data points across global markets in a fraction of a second.
So they're just coldly playing the math.
Yes. They aren't trying to hit home runs. Systematic investing is about finding tiny micro inefficiencies in pricing and exploiting them relentlessly.
Just grinding out those basis points every single day.
Exactly. Over 10 years, those mathematical wins compound. That's how you get a 96% outperformance rate.
And when a sovereign wealth fund or a massive pension plan sees that kind of 10-year reliability.
They back up the truck. They need mathematical certainty to meet their liabilities, not a charismatic human manager guessing on a stock.
That makes total sense. Okay, let's shift gears and look under the hood at the accounting, because this is where the earnings report gets a little dense.
Yeah, the GAAP versus E&I split.
Right.
Yeah.
So U.S. GAAP net income was reported at $27.3 million, but then management heavily highlights economic net income, or E&I, which is way higher at $47.5 million.
They're like double.
Yeah. And the press release says the GAAP number is dragged down by, quote, non-cash expenses representing changes in the value of Acadian LLC equity and profit interests.
I know, it sounds like complete financial engineering jargon.
It really does. To a lot of investors, non-GAAP metrics sound like a company just trying to hide their expenses.
Yeah.
So is this just an accounting gimmick, or is E&I the real deal?
It's definitely the real deal. It actually gives you a much more honest reflection of the cash the business is printing.
How so? Walk us through the Kirk.
Well, think about their business model. Their entire edge is the sheer intellectual horsepower of the quants and data scientists building these models.
Right, and the competition to hire those guys is insane. Every hedge fund wants them.
Exactly. So to retain them, Acadian gives them a significant piece of the upside through profit sharing and equity in Acadian LLC.
Makes sense.
But under U.S. GAAP rules, Acadian has to mark that employee-earned equity to its current market value on the balance sheet.
Oh, I see where this is going.
Yeah. So when Acadian kills it, this quarter growing AUM by 54%, the overall value of the firm spikes, which means the value of that employee equity spikes.
And GAAP forces them to record that increase in equity value as an expense on the income statement.
Bingo. Even though absolutely zero cash left the bank account, it hits the books as a massive loss.
Yeah, is wild. They literally get punished on paper for having a great quarter.
Exactly. It artificially suppresses their GAAP net income.
Hmm.
So management uses E&I to strip out those non-cash revaluations.
So E&I strips out the accounting noise.
Yeah.
And that $47.5 million is the actual cash-generating power of the firm.
Exactly. Now, to be clear, they do track the actual cash they pay their people. Key employee cash distributions rose 128% to $9.1 million this quarter.
Right. They aren't hiding the real cash comp.
Not at all. Variable comp was up. But separating out the non-cash equity stuff is just crucial to see how the underlying engine is performing.
Okay, so that brings us to capital allocation. They're throwing off all this free cash flow. How are they rewarding the shareholders?
Well, they have an incredibly disciplined approach
Yep.
and a totally pristine balance sheet.
Yeah, looking at it, they've got $64.6 million in cash, but there's also $109.8 million in seed investments.
Which is basically their internal R&D budget.
Right. They take their own capital, seed a brand new algorithm, and run it for a few years to prove it works before selling it to clients.
You have to. You can't just pitch an untested model to a pension fund. That seed capital guarantees their future organic growth.
Yeah, keeps the pipeline full. And on the debt side, they're super conservative. Gross leverage of 0.8x, net leverage of 0.5x.
Barely levered at all.
And they generated so much cash, they entirely paid down their seasonal revolver borrowings this quarter,
Paid it down to zero. So they are completely insulated from any short-term rate shocks.
which leaves plenty of excess capital for the stockholders.
Yeah.
They repurchased 200,000 shares in Q2 for about $10.6 million.
That was at a VWAP of around $69.92, I think.
Yep, $69.92 per share, plus a quarterly dividend of 10 cents a share payable in September.
And if you zoom out, they've returned $1.5 billion in excess capital to stockholders since the end of 2019.
$1.5 billion. It really highlights their priority stack, right? Free cash flow goes to R&D and the balance sheet first, then straight to buybacks and dividends.
It's a textbook flywheel effect. Strong performance brings in $4.3 billion in net flows. AUM swells to $232 billion.
The operational leverage kicks in, margins expand past 40%.
Right. They take that cash, seed new strategies, zero out the revolver, and buy back stock.
Which just shrinks the share count and juices the EPS even more for the remaining investors.
It's a completely closed-loop, self-reinforcing machine.
It really is a masterclass in capital efficiency.
Yeah.
And that's what makes this quarter so fascinating to dig into. Acadian isn't just riding a market wave. They've engineered a highly durable system that just aggressively compounds.
Absolutely.
Maintaining a 96% beat rate over 10 years, through sheer algorithmic discipline is what fuels the entire thing
It does leave you wondering, though, looking at the broader industry.
about active managers.
Yeah. I mean, if a pure play systematic quant firm can consistently beat 96% of its benchmarks over a decade using just data and automated processing.
You have to ask if human-led active management is just eventually going to become a bespoke artisanal niche.
Right, like a luxury product for investors who just want a good story rather than the industry standard.
That is a phenomenal point to leave you on. Keep looking past those headline JAP numbers to find the true economic reality of these businesses.
Always.
And be sure to follow the show for our daily earnings coverage, because we're going to keep breaking down the numbers that actually move the markets all season long.